All investing has its risks. For short sellers, there is also the asymmetric risk in holding a short position. You hope that the stock you shorted goes to zero. It's a known outcome with a maximum return. But on the upside, a stock can double or triple, or do much, much more. There are, in effect, unlimited risks. That's why short sellers should always be wary of the short squeeze. A short squeeze is a relatively regular event that can drive up the price of a share in the face of the short seller. If not managed properly, it can see a fundamentally sound position quickly become a risk management nightmare. The short seller could end up nursing big losses, even being forced to buy back the shares, unwinding the position that had taken time and effort to research and build up. Roger Hirst of Real Vision outlines the key drivers of a short squeeze that all short sellers need to factor into their risk management process. It's all about being prepared and understanding the risks that you're taking on when you enter a short position.
If you're a short seller, you've probably learned about this phenomenon firsthand. It's unavoidable if you spend your career on the short side of things. Today we'll be discussing the dreaded short squeeze. Remember, short sellers have generally borrowed a stock from a long holder and then sold it short in the market. So what is a short squeeze, and how can we avoid being caught in its crosshairs? At its most simple, a short squeeze occurs when short sellers of a stock get caught offside by a rising share price and are forced to buy back their shares. Buying back shares that are short is called a short cover. Sometimes the overwhelming buying demand creates a self-fulfilling cycle. As the stock rises, the short sellers experience even bigger unrealized losses, which increase the likelihood that they will need to buy back their shares. If the short holding base is big enough, this can cause a double-digit price increase, or perhaps even more, without any fundamental reasoning. The upside is theoretically unlimited. Look at what happened to Volkswagen in 2008, and this was in the midst of the great financial crash, when equity markets were collapsing. So what should short sellers be paying attention to in order to avoid getting caught in the wrong side of a short squeeze? Well, the most important thing to watch is something called short interest. Short interest is the number of shares that have been borrowed and not yet given back or closed out. It can be expressed as a number or as a percentage of the total number of shares available, and it serves as an indicator of just how much upside potential there could be for a short squeeze. If the short interest is 10%, that means that 10% of the available shares to trade have been borrowed and sold short. Anything in double digits would be considered a decent size of short position. If short interest is extremely high, that often reveals overly pessimistic expectations. In this scenario, your risk versus reward for being on the short side isn't very high, and the odds of a short squeeze increases immensely. In other words, your potential for losses increases as more investors short the stock. You'll often hear about investors saying stocks with a large short base are more vulnerable to a large short squeeze. It's also important to understand how liquid a stock is in these scenarios. It's imperative to understand liquidity when short selling. Liquidity is the ability to buy and sell something for cash. If something is very easy to buy or sell, that means it's very liquid. If something isn't very easy to buy or sell, that means it's illiquid. There is a massive difference in liquidity when selling a bottle of water than, say, a Methuselah of champagne. Stocks work in the same manner. When a stock is illiquid, there is usually a bigger gap in price between the buyer and the seller. And when you trade the bid or the offer, there will be fewer shares available to transact than in one of the more liquid names. That usually happens when the holder base of the stock is pretty homogeneous. That might mean, for instance, that most of the holders of a stock are pension funds, holding the stock for the very long term, with little intention of trading in and out of their positions. The wider the stockholder base is, the more likely the liquidity of that particular stock is very good. A wide stockholder base would include hedge funds, retail investors like me or you, as well as the usual institutional investors such as asset managers and pension funds. Take the example of Apple. Nearly everyone in the world owns a tiny piece of Apple stock, while not everyone will own the small cap stock in Sweden. Therefore, a small cap stock in Sweden has a smaller holder base, and its value is determined by a smaller set of investors. But remember, a large cap stock with a small and homogeneous holder base can be more liquid than a small cap stock with a very diverse holder base. Large size doesn't always mean a large free float and good liquidity, and small size doesn't always mean poor liquidity. To take it a step further, short sellers need to understand the dynamics of why the liquidity is better or worse, and that is where we encounter the share float. The term float refers to the common shares that a company has issued to the public that are available for investors to trade. This figure is derived by taking a company's outstanding shares and subtracting any restricted stock, which is stock that is under some sort of sales restriction. It can be the case that the insider holders of a stock, and inside holders could be the founders or the CEO, they can't transact, and so that reduces the number of shares that are available to trade on an open market. A large cap stock where a large proportion of the shares are closely held by insiders may therefore be relatively illiquid. The Saudi giant Aramco is a much larger company than Exxon of the US, but because only a tiny fraction of its market cap was floated in its recent IPO, this company is far less liquid, despite its larger size. The difference between market capitalization and available shares to trade is a very important thing to note. If there is a large short interest in a stock whose holders are restricted from trading, or the free float is only a tiny proportion of the market capitalization, that reduces the pool of potential holders and massively increases the probability of a short squeeze. As with the Aramco example, new IPOs, that's an initial public offering of shares to be listed on an exchange, they have low floats because insiders are restricted from trading for months and months. That's why new IPOs are way more volatile as well and can experience massive swings in value. These stocks are easier to short as a lockup of restricted shares becomes available to trade on the open market, increasing the available free float. That's free for everyone to trade. Therefore, before putting on a short position, you should really dig into the size of the float and the potential holders of the stock. Understanding this phenomenon often separates the winners from the losers, especially in an overly illiquid market as we're in today. Liquidity can exacerbate price movements because if the holder base isn't large enough, it takes less trading volume to move the price further. The indicator to watch in this case is the days to cover ratio. This is the number of shares sold short divided by the average daily trading volume. A stock with a large market capitalization can still be illiquid if the average daily volume of its shares that are traded is low. If the days to cover ratio is also high, along with the overall shares held short, the potential for a short squeeze grows astronomically. In very liquid stocks, with high short interest and a high days to cover ratio, the news can just go from bad to less bad in order for a short squeeze to occur. Some retail investors will actively target illiquid stocks with a high level of short interest to see if they can create some upside momentum that forces the short to cover their position. So it's very important to be aware of the risks in short selling and know that there are dynamics at play that make shorting twice as hard. A shorted stock can go to zero on the downside, a finite gain, but it can theoretically have an unlimited loss on the upside. Short sellers therefore have to manage their positions accordingly. We hope we've given you some tools here to avoid the pitfalls of a potential short squeeze. Thanks for watching, and we'll see you next time.
Short squeezes can quickly turn a seemingly sound fundamental position into a scramble to cover losses. Volkswagen during the Great Financial Crisis was an extreme example. But Tesla was a well-known favourite of short sellers that rose 12-fold, from $50 to over $600 between late 2019 to December 2020. Losses therefore can be unlimited, and this basic fact needs to be factored in by all who take a short position. Roger specifically outlined two critical factors to watch for. Short interest, which is the number of total shares that are free to trade that have been borrowed and sold short. This is usually expressed as a percentage of available shares. Days to cover, which is a measure of liquidity that represents the number of days it would take to unwind a position based on the average number of shares that trade per day. Remember, a big stock is not always a liquid stock if that stock is held by a small number of long-term investors. A stock with a large variety of investors, some short-term and some long-term, should have better daily trading qualities. Therefore, size your position accordingly, and as part of your short thesis, you need to look at the basic fundamentals of the stock. And you need to look at the popularity of a short position in terms of both the number of shares available to trade and the number of shares that trade on a daily basis. At the end of the day, short squeezes are relatively common events that can be managed, as long as you factor in these potential risks. We hope you enjoyed this production of Short Selling 101. Thank you, and see you next time.